Stop what you are doing right now. I do not care if you're at work. I do not care if you are cooking dinner. I do not care if your kids are screaming in the background. What happened in the last 72 hours changes everything. While you were sleeping, while you were checking your normal news feeds, while the mainstream financial media was talking about interest rates and earnings reports, the Middle East caught fire. Iran and Israel are now in active military conflict, not proxy conflict, not diplomatic tension. Active military strikes, missiles flying, infrastructure targeted, casualties mounting. And here is what nobody in the silver space is telling you correctly. This is not just a geopolitical story. This is not just a headline for the evening news. This is a precious metals repricing event happening in real time. Let me tell you exactly what happened, because the details matter. On February 28th, 2026, the United States and Israel launched coordinated military strikes against Iranian nuclear and military facilities. Not symbolic strikes, not warnings, not messaging operations, strategic strikes. Facilities were hit in Tehran, Isfahan, Karaj, and Kermanshah. These are not random targets. Natanz, Iran's primary uranium enrichment facility. Fordow, the hardened backup enrichment site built inside a mountain. Isfahan, nuclear research and missile production infrastructure. These are the core pillars of Iran's nuclear program. The Pentagon confirmed the operation using two words that matter for markets. Ongoing, massive, not completed, not finished, not limited. Ongoing. That word matters. It means this is not a one-night strike. It means this is the beginning of a military campaign, not the end. President Trump announced the action publicly, calling it necessary to prevent Iran from acquiring nuclear weapons. Israel called it a preemptive strike to eliminate existential threats. Iran responded within hours. Missile strikes on U.S. military bases, strikes on Israeli territory, threats against Gulf state infrastructure, regional retaliation warnings. The Iranian Revolutionary Guard issued a statement declaring that any nation hosting U.S. military assets is now a legitimate target. Translation: Saudi Arabia, Kuwait, Bahrain, Qatar, UAE. All are now potential targets. This is not a contained conflict. This is not a localized engagement. This is a regional war in the early stages of escalation. Now, why does this matter for silver? Reason 1. Safe haven. Flow's capital moves into hard assets during geopolitical uncertainty. Gold, silver, physical commodities. This is documented behavior across decades of conflict. Reason 2. Oil risk. The Strait of Hormuz handles 1,020% of global oil supply. Iranian military doctrine explicitly includes mining the strait, missile strikes on tankers, energy infrastructure attacks. Oil disruption. Inflation expectations. Inflation expectations. Lower real rates. Lower real rates. Bullish precious metals. Silver benefits twice. Safe haven demand. Inflation repricing. Reason 3. Supply chain. Disruption. Silver is already in structural deficit. COMEX registered inventory is now only 88 million ounces. That is deliverable supply for the entire futures market. March open interest alone represents 1.8 million ounces. More claims than metal. Any supply friction becomes an accelerant. Let me be clear. I am not celebrating war. I'm not glorifying conflict. People are dying. Families are suffering. But pretending war does not affect markets is not morality. It's blindness. Let's look at history. 1990, Gulf War. Gold, 360, 412, plus 14%. Silver, 4, 5, 25%. Silver outperformed gold. 2003, Iraq War. Gold, flat. Silver, 0.5%. Silver outperformed gold again. 2020, Soleimani strike. Gold, 4 or 5% in 48 hours. Silver, 0.3% in 1 week. 2023, Gaza conflict. Gold, plus 11%. Silver, but 16%. Again, silver outperformed. The pattern. 1, metals gap up immediately. 2, silver usually outperforms gold. 3, duration of rally, duration of conflict. 4, oil risk amplifies moves. 5, physical tightness magnifies price action. Now apply that to today. Conflict is ongoing, not proxy. Direct state conflict. Hormuz risk exists. Silver market is already structurally tight. Physical inventories are historically low. Industrial demand is at all-time highs. This is not a normal market environment. Price action gold during hours trading. Dot numbers 5,278 Oz. Gap up move 1.9%. Silver trading at 94.30 Oz. Recent surge. Publishes 8%. Physical market signals. Shanghai premium. Shanghai silver $10 premium per ounce over COMEX. That is physical stress pricing. COMEX registered inventory. Whatever. Only 87 to 88 M Oz. March. But open interest. 114.8 Oz claims. Deliverable metal, Silver lease rates, we're going to go 7% plus. Normal is 0.3, 0.5%. That is not a normal market. That is physical scarcity pricing. ETF holdings, SLV 518M, OZ, PSLV 217ME, OZ. Institutional physical exposure remains elevated. Summary, gold is moving, silver is moving faster. Physical indicators are tight. Delivery pressure is high. Lease rates signal stress. Asia is paying premiums. This is not paper speculation. This is physical demand. Accountability time. Existing prediction. Silver above $36 by April 1st. Confidence upgraded to moderate. Yes, that target is already blown through in reality, which proves the structural thesis was correct. New crisis. Prediction. Current silver price drops to $94.30. Target. $105 per ounce. Time frame within 14 days. Expiration March 16th, 2026. Confidence level moderate high, 65-70%. Invalidation level $89. If silver breaks below $89 with volume, I log early invalidation. Why moderate high? 1. Historical precedent. 2. Physical tightness. 3. Escalating conflict. 4. Oil disruption risk. 5. Delivery stress. 6. Lease market stress. 7. Inventory scarcity. Why not high confidence? De-escalation risk, global liquidity shock risk, dollar spike risk, cross-market liquidation risk. There are real risks, and I acknowledge them. Prediction is now live, logged, public, trackable. COMEX delivery pressure. 114.8 M Oz claims, 87 M Oz deliverable structural stress. Mining sector. Supply growth cannot respond fast enough. New production cycles take years. Energy cost rising. Security risks rising. Jurisdictional risk rising. Institutional positioning. Hedge funds remain underweight relative to historical bull markets. Speculative fuel still exists. Viral claim addressed silver to 200. Possible in extreme escalation scenarios. Not guaranteed. Depends on duration, oil disruption, and financial contagion. First, let's talk about geopolitics. We're seeing a significant escalation in conflict, particularly around crucial shipping lanes. Activity in the Strait of Hormuz is becoming a major point of concern. This isn't just background noise. It has a direct and immediate impact on the global economy. Unsurprisingly, with these tensions rising, oil prices are on the move. We're seeing a clear upward trend as markets price in the risk of potential supply disruptions. This is a classic example of how geopolitical instability can ripple through the financial world. Now, shifting our focus to Asia, the Shanghai Premium is telling an interesting story. This premium, which is the price difference for physical metal in Shanghai compared to London, remains robust. It signals strong physical demand in the region, which is a key indicator to watch. Alongside this, we're seeing lease rates for physical assets stay firm, which further supports the idea that the market for tangible goods is tight. Let's look at the futures market, specifically COMEX. We've been observing significant withdrawals from their warehouses. This reduction in available inventory is a bullish sign, suggesting that more participants are opting to take physical delivery rather than just trading paper contracts. Speaking of which, the number of delivery notices being issued is also on the rise. When you see more people standing for delivery, it shows a genuine demand for the underlying asset, not just speculative interest. On the other hand, we have to consider the paper market. ETF flows have been somewhat mixed, not showing the same decisive direction we see in the physical markets. This creates a fascinating divergence. And of course, we can't ignore the US dollar. The dollar has shown considerable strength recently, which typically acts as a headwind for commodities priced in dollars. So, what does this all mean when we put it together? The correlation structure is shifting. Normally, a strong dollar would push down commodity prices, but the physical tightness and geopolitical risks are creating a powerful counter-narrative. The physical market appears to be overpowering the paper market's influence. Based on this analysis, our target for the near term is in the $100 to $105 range. However, risk management is crucial. We would consider this outlook invalidated if prices break below the key support level of $89. It's a dynamic situation, and things can change fast. Optimists say silver explodes. Pessimists say manipulation crushes it. My job is not hype. My job is accountability, prediction, tracker, public record, evaluation. Here's where we stand. War. Active escalation risk. High physical silver, tight inventory, low demand, high delivery pressure, high lease rates, elevated institutional exposure, rising safe haven flows, active predictions. 1. Silver, $36 by April worse. Still lives. 2. Silver, 102 or 105 by March 16th, 2026. Moderate high confidence drop tracker in the comments. Subscribe, turn notifications on, check the pinned tracker, hold me accountable. War is terrible. Markets are real. Data matters. Accountability matters. The predictions are live. The tracker is public. The crisis is ongoing. Data-driven, accountable, independent. This is the Stack Guy. I'll see you in the next update.